Momentum, in the context of the stock market, refers to the rate of change in price. It's like a snowball rolling down a hill. The faster it rolls, the bigger it gets. Momentum indicators are tools that traders use to measure this rate of change. These indicators help us understand not just the direction of price movement, but also its strength and the likelihood of it continuing. Imagine trying to push a heavy object. The initial push requires the most effort. Once the object starts moving, it's easier to keep it going. Momentum indicators highlight when a price trend is gaining or losing strength. They can signal whether a price move is likely to continue or if it's losing steam. By understanding momentum, traders can better time their entries and exits in the market. The Relative Strength Index, or RSI, measures recent price changes to evaluate overbought or oversold conditions. It oscillates between 0 and 100. Readings above 70 are overbought, below 30 are oversold. Think of RSI as a car's speedometer. A high reading suggests the car is moving too fast and might slow down. A low reading indicates the car is moving slowly and could speed up. Traders use RSI to identify potential trend reversals. The Moving Average Convergence Divergence, or MACD, is a widely used momentum indicator that identifies trend changes. It shows the relationship between two moving averages of prices, typically the 12-day and 26-day exponential moving averages. The MACD is represented by two lines, the MACD line and the signal line. When the MACD line crosses above the signal line, it's considered a bullish signal. Conversely, when the MACD line crosses below the signal line, it's considered a bearish signal. Traders use the MACD to confirm trend changes and identify potential trading opportunities. Spotting divergences. Divergences occur when the price of a security and a momentum indicator move in opposite directions. This can be a powerful signal that the current trend is weakening and a reversal may be imminent. For example, a bullish divergence occurs when the price of a security makes a lower low, but the RSI makes a higher low. This suggests that the bears are losing momentum and the bulls may be regaining control. Conversely, a bearish divergence occurs when the price of a security makes a higher high, but the RSI makes a lower high. This indicates that the bulls are losing momentum and the bears may be taking over. Traders use divergences to confirm other technical signals and identify potential trend reversals. For example, if a stock is in an uptrend and makes a new high, but the RSI fails to make a new high, it could be a sign that the uptrend is losing momentum and a reversal may be imminent. Momentum indicators in action. Momentum indicators like RSI and MACD are valuable tools for any trader. They provide insights into the strength of price trends and can help identify potential trend reversals. By understanding how to interpret these indicators, traders can make more informed trading decisions and potentially improve their profitability. Remember, no technical indicator is perfect, and it's important to use momentum indicators in conjunction with other technical and fundamental analysis tools. However, by incorporating momentum indicators into your trading strategy, you can gain a deeper understanding of market dynamics and potentially improve your trading results.